when the reverse repo facility dries up, the money supply starts tanking again. What happens when they're trying to issue, let's say, $1 billion and only 900 million comes to the table? That's a failed auction. It's not a matter of if that happens, it's most likely a matter of when. The government then has to go into emergency mode.
What's up, guys? I'm nobody special, and I'm very happy I got my friend Joe Brown from Heresy Financial is back with us today. We're going to talk about the reverse repo and the countdown. Reverse repos just keep falling. The ground's getting closer. What happens when it hits zero? Joe, how you doing today, brother?
Pretty good. Thanks for having me on.
Thanks for doing this on short notice. So I'm going to shrink my head here, bring up on the screen. This just hit the tape a few minutes ago. Reverse repo down another, what are we down? Like another 32 some odd billion today. 912 billion left in the reverse repo. We're down 108 billion just since Monday. Down over 1.3 trillion since they suspended the debt ceiling. First, talk to us a little bit about what we're looking at here, about, maybe just real high level, real quick, what the reverse repo is. Why should people care first? And then we'll talk about what happens after.
Yeah, absolutely. So let's go take a little bit of a trip back in time before the financial crisis. Banks don't carry a lot of cash on hand. And so at the end of the day, a bank will say, hey, I actually need some cash to, close out for the end of the day. Another bank will say, well, I've got some extra cash. And so the bank will say, all right, here's some collateral of mine. Give me the cash. And I promise to repurchase it from you at a later date, whether that's overnight or longer. That's why it's called the repo market. It's repurchase, not repossess. Basically, if you've ever, been to a pawn shop, that's, that's what this is. So I'm going to give you some U.S. Treasuries. You give me the cash, and I'll buy I'll buy those Treasuries back from you at a future date. When the financial crisis hit, the reason why it blew up and could have taken down all the big banks really quickly is because the collateral that was being used in those exchanges was mortgage-backed securities primarily. And very quickly, none of the banks wanted to accept that, accept mortgage-backed securities as collateral because they realized they knew it was bad collateral. But everybody needed cash. Nobody had the cash. And so that's why the Federal Reserve at that point intervened in the regular repo market and started being the one to inject the cash into the repo market, and they accepted the collateral because nobody else would. One of the signs of distress in the regular repo market is the interest rate being paid for that cash just spikes. Because they need the cash, so they say, okay, I'll pay anything. And so that's when the Fed intervened. Fast forward to September of 2019, the repo rate, the rate paid on cash in the repo market, spiked again. And everybody was pretty concerned because they're like saying, hey, this is the same thing that happened right before the financial crisis. Do we have bad collateral in the system again? Well, it turned out that time it wasn't an issue of bad collateral. It was an issue of no cash. Essentially, the U.S. government had been borrowing a ton of money, and the Federal Reserve had been tightening. And so there wasn't all this excess liquidity. There wasn't enough cash. And so everybody's collateral, they all had treasuries, but they all went to each other and said, here, take my treasuries. I'll take your cash. But everybody was trying to do that. Nobody had the cash. So the Fed had to intervene again and be that counterparty in the repo market to give cash to take the collateral. That way the rates stayed low enough and financial institutions wouldn't collapse. COVID happened, the money printing happened, and the way that the money printing works is that the Fed has to buy something in order to print the money because they have to credit that cash to somebody's account, one of the bank's accounts. And the way they do that is by buying something from them. So the Fed bought a bunch of U.S. Treasuries from banks. Banks then turned around and took that cash and bought new treasuries from the government, loaned that money back to the government. What does the government do with that money? They spend it, which goes into somebody's bank account. So it's a really roundabout way, but that money printing ended up trillions of dollars entering the banking system. So suddenly, you don't have a problem of not enough cash in the system anymore. Your new problem is too much cash in the system. You might think, well, how is that actually a problem? And it's because deposits are a liability for banks. So when you put $1 in the bank, that bank now owes you $1. If they don't do anything with that dollar, then they're losing money because they have to keep the lights on. They have to, pay the salaries, utilities, rent, mortgage, whatever. So they've got costs. So they owe you that dollar back. Now they have to go do something with that dollar in order to make some money so that, they have an asset to offset that liability. You're the creditor. You're loaning that dollar to the bank. What they normally do is they purchase short-term U.S. Treasuries with those short-term deposits. Well, the problem is there's so much cash that just entered the system. There's not enough short-term debt in the market for them to go out and buy. So if they went out and bought a bunch of U.S. Treasuries, it would have driven rates negative. Because remember, all of the treasuries that were there just got bought by the Fed. So they're not out in the system anymore. So now you have institutions needing to do reverse repurchase agreements where institutions are saying, hey, take my cash. I need some collateral because I've got all these deposits that I need assets to offset. And so that's where we get the beginning of the usage of the reverse repo facility. If you pull up the chart and go do like a 5-year view on the chart, you'll see the moment when it started to get used was April of 2021. So you might think, okay, why did it take so long when the money printing happened earlier? It's because for 1 year, the Federal Reserve suspended the rule about banks having to have offsetting assets for their liabilities.
That was the supplementary leverage ratio when they exempted it, right?
Exactly. Correct. Yep. And so that suspension, that temporary suspension ended in April of 2021. Suddenly banks needed collateral. It wasn't available on the market. So they went to the Fed to get it through this reverse repo facility. Then it really started to skyrocket. I believe it was June of 2021, just a couple months later, because the Fed started to pay an interest rate into this. So not only could banks or financial institutions put their cash here and get their collateral that they needed, but they also started getting paid 5 basis points on that cash, which doesn't seem like a lot, but it's it's 5 basis points at that time. Interest rates, the Fed funds rate was at 0. So the reverse repo rate is always 5 basis points higher than the bottom end of the Fed funds rate. So it's just enough to attract cash in there. It's a way to keep cash in there and keep a lid and a floor on interest rates.
So real quick, if I could pause you, Joe, this is also a method of fighting inflation, wasn't it, when they created the reverse repo, because it gave this money someplace to go that wasn't the U.S. Treasury market or wasn't new loan creation, which are all things that would be inflationary if the money flowed into there, right?
Well, at that time, I don't remember when the Federal Reserve kind of shifted to start trying to fight inflation. I think it was a little bit after that, actually. It was towards the end of 2021, if I remember correctly, when they started saying, hey, we're gonna start fighting inflation now. I think the main factor that drove them to start paying a rate in there was because there just wasn't enough collateral outside the system. It was gonna push rates negative if financial institutions had to go out and buy all of that from the open market. And so they wanted to keep that cash out of the open market to kind of keep rates a little bit above whatever the reverse repo facility was paying. Because if you go and buy a T-bill, even if it's for 2 months, there's still the risk that you may need to sell that T-bill, and or I shouldn't say T-bills, treasuries. There may be a position in which you have to sell it prior to maturity. The price may change. There's some default risk, even if it's close to 0. But if you have cash in the reverse repo facility, that rate gets paid to you directly from the money printer. So it's the only 0 risk place for cash to hang out. And so it keeps a floor under interest rates. And then, they slowly started raising interest rates pretty quickly from there. And every time they did that, they started increasing the amount they were paying in here, which just sucks more and more money into here from from circulation until it got to 2.3 trillion, basically absorbing all the excess cash that had been circulating in the system. Now, if we go to May of 2023,
Okay, let's zoom in a little bit here.
7 months ago.
May of 23. Here we go. Peak debt ceiling, right?
Yep. So it was still about 2.3 trillion at that point. And from there, it started to fall. If we pull up a chart of 6-month treasuries.
Okay, let's go to about, we'll start with the same time frame around May right here.
Yep. Right around May of 2023, we can see finally rates got up above when you maybe over the next month, rates got to a point where they were paying enough more than what the reverse repo facility was paying to where that started to suck cash out of the reverse repo facility. So what financial institutions are using reverse repo? It's going to be mostly things like money market funds. So if I'm a money market fund, I have two needs. Number one, I have to get the highest interest rate possible. Number two, I have to have it extremely liquid because money market funds are dollar for dollar. They don't fluctuate in value. And so managing a money market fund, I'm going to put it in something. I'm going to collect a very small piece of that interest rate, pass the rest on to the holders, to the shareholders, to the people who put the dollars in the fund. And so if the reverse repo facility is paying 5.05%, and T-bills are paying 5.1%, well, I'm going to keep most of it in the reverse repo facility. But if T-bills are paying 5.5%, well, now I'm going to take some out of the reverse repo, put some in T-bills. Now I'm getting on average a higher rate, but I still maintain virtually all my liquidity, and I can pass on a higher interest rate to the investors. And so the government borrowing that has been taking place over the last 6 to 8 months has relied heavily on this short term, on T-bills, because there's $2.3 trillion available for them to borrow from that they can pull from, and it won't push interest rates higher. And that's what's been going on for ever since May. And we can see it drains with every T-bill issuance. And we've got about $912 billion in there left. And if the Treasury continues to rely more and more on issuing short-term debt instead of long-term debt, it will drain this faster and faster. But why not? They can borrow as much as they want at the short end of the curve right now without having to worry about liquidity issues, about it, driving interest rates higher.
And we did just find out with the QRA that came out about 2 weeks ago that they are going to be leaning a little bit more heavily on the short end of the yield curve over the coming months. So this decline is going to continue, if not steepen, for the foreseeable future, isn't it?
Yeah, correct. So if we plot this out, you can see if we just go back to May, from May until now, it would probably take until about March for this thing to hit zero, maybe April. Yeah. But recently, the pace at which it has started to drain has accelerated. And so if you plot, that line from, the last month and a half of how fast this thing has been being drained, we're looking at, January probably when this thing runs out. So I'm not going to make a prediction whether it's going to be January or April or anywhere in between. That's a pretty safe range to me, somewhere in between there when this thing runs out. When this thing runs out, keep in mind, it doesn't mean the government has satisfied its appetite for borrowing. It just means there's no more easy money for them to borrow from. And a recent Treasury auction that leaned a little bit more heavily on long-term borrowing happened. It was a week
last
ago.
Week on Thursday, right? I think.
Yep. Yeah.
The 30-year you're talking about.
Yep. And it was abysmal. You can look at the way that you can look at we can get into it if you want, but basically there's a couple of measures you can look at: the bid to cover ratio and the size of the tail. And this is one of the worst auctions that they've had in a long time. And so they'll get to the end of this reverse repo facility, and then they'll have to really be strategic about where they're borrowing from, because there's not going to be much liquidity left.
Actually, you just put out a video today on that subject. You mentioned the 30-year auction from last week, the size of the tail, the bid to cover ratio. So I'll put a link to that video that you did down in the description here. Highly recommend you guys check that out when this one is done, because there's plenty more to talk about here. And yeah, that was a very interesting auction, because big fat 5 basis point tail. Still plenty of bid, right? The bid to cover was 2.4, I think, or 2.24, but a lot lower than we've seen in a long time. And, you know, you painted the picture in your video you did today. I use the analogy of the cookie jar or the candy bowl. You know, you're just sitting there munching, and you reach in, and, you know, one day you're going to stick your hand in the cookie jar there, or the bowl of chips, and there's nothing there.
Yeah.
Then what happens?
Yeah.
So say reverse repo goes to 0. Maybe it happens in February, maybe April, maybe they're able to get creative and delay it. But what happens when we get to 0? The government goes, they do an auction. We want to auction off 100 billion or whatever of whatever year debt. Reverse repo's empty. Now what?
Yeah. Yeah. Let's talk about that. So just a quick recap about what happened last Thursday, because it's what we're going to see going forward. When the government tries to borrow money, they do it through an auction. They sell the debt, and they say, hey, I want to issue debt, let's say at 5%. And there's going to be some people that say, okay, yeah, I'll do 5%. And then there's going to be institutions who say, I'll lend to you, but only if I can do it at 5.05%. And typically, what happens is, first the government goes to all the people who agree with their rate. Then they go to all the people who wanted a higher rate, and they go from the bottom up. So if the last person that lends money to the government gets it at 5.02%, well, that means everybody gets it at 5.02%. And so it's actually a pretty big deal when the number of dollars that are available for them to borrow from starts to decrease, because that highest dollar, that last dollar that they have to borrow from, is usually going to be higher and higher. And that's the rate that everybody gets. And so when we look at what happened last Thursday, the difference between what the government wanted to borrow at and what they ended up borrowing at was 5.3 basis points. Doesn't sound like a lot, but that's a record going back to 2016. Usually it's much smaller than that, 1 basis point difference, or, even the opposite, where they get it for lower. So that's a big deal, but we're going to see more and more of that as liquidity dries up, because there's fewer dollars available. So the dollars who are saying, hey, I want a higher rate, will win those auctions. So what happens when they're trying to issue, let's say, $1 billion, and only 900 million comes to the table? That's a failed auction. It's not a matter of if that happens, it's most likely a matter of when. Won't happen before the reverse repo facility dries up, but it's almost certain to happen within 6 months after the reverse repo facility dries up. So we're going to see a couple of things. Could you pull up the chart of M2? So this is the money supply, which we don't get this data for, at most recent, we have a month, we're a month behind with this data. So what you'll notice is the money supply was falling as the Fed was tightening until it hit May of 2023, and then it started moving sideways. Well, what do we remember from earlier about what happened in May of 2023? That was the moment when funds started to come out of the reverse repo facility. And so government borrowing basically just hit a point where it started sucking money back into circulation because rates were so high. So that's why the money supply has flatlined since then, because the government borrowing, sucking that reverse repo facility money and then spending it back into the banking system, that has almost perfectly offset the Fed's tightening, which has been sucking money out of circulation. So we had the money getting sucked out of circulation until May of 2023. And then for the last 6 months, 7 months, it's been stagnant because that reverse repo facility has been getting re-entered into the banking system. So assuming nothing changes here and nothing massive breaks, what will happen first when the reverse repo facility is drained is this thing starts heading much lower again, because we still have those deflationary forces, what the Fed is doing with tightening, the higher interest rates, the quantitative tightening. This starts to head lower again. Now, the question is, how long will that last, or will it even last, a month? And that, is to be determined. But that's also one of the reasons why we saw the inflation rate flatline around the 3 to 4% over the same time frame, because the money supply has stayed stagnant. So we were seeing the inflation rate come down dramatically because the money supply was coming down dramatically. But now the money supply has flatlined. And so the inflation rate has flatlined around 3 to 4%. Now you might say, well, that still means prices are growing. How is that happening even though money supply isn't going up? That's because there are other inflationary forces at work, like the wealth destruction effect of a higher government burden. And we have the deglobalization taking place. We have higher energy costs. We have all sorts of inflationary pressures now that are winning in conjunction with the money supply not dropping. So what happens when this comes to a head? Well, we get a failed auction. The government then has to go into emergency mode because they're trying to borrow money and nobody is lending to them at that point. So the only fix for this, well, there's only two outcomes, I should say. Outcome number one is default. Now, default doesn't happen immediately because they still have the Treasury General account, which right now has $700 billion in it. So they have, or maybe if you have the chart, I think it's about $700 billion. It might be a little bit more right now. That's about maybe $800 billion. Janet Yellen really likes to have a big slush fund in the Treasury General account. Yeah, okay, so $772 billion so right now. Yep. And that way, if there's an emergency, which she's faced plenty of fiscal emergencies in her tenure at the Treasury.
That won't happen again in her lifetime, by the way.
Right. So every time this happens, she's like, now I got to spend this back down again. And we have, a couple of month time frame until this hits zero. So she likes to keep this thing pretty full because she knows she's going to have to rely on this without borrowing more for a certain amount of time. So this is step number one. They rely on the money in the Treasury General account since they couldn't borrow that last, let's say, $100 million or so. Now, that's a stopgap solution. So if nothing changes, they end up defaulting because they don't have enough money coming in to pay off the maturing debt. It's not a 0% chance, but it's a very low percent chance that they just default. What will most likely happen is they will go to the Federal Reserve behind closed doors and say, this is a systemic crisis. The dollar will fail. Treasuries will collapse. The whole entire global financial system will collapse unless you not only stop QT, but restart QE so that there's money coming into the system for us to borrow from again. So that will likely happen. Although one wild card is that recently Jerome Powell has been very vocal about not doing things like that. For the first time, he's been saying things like, under no circumstances will we help the government's financially irresponsible situation or refinance the debt. That he's been critical of the fiscal irresponsibility recently. So there is a chance that Powell just says, hey, we still got inflation. We can't return to QE. We have one mandate given to us or two mandates given to us by Congress. One of them is inflation. We can't do something that will actively stop us from doing what Congress has told us to do. In that case, the Congress will get together and they'll amend the Federal Reserve Act again. They've done it before. They did it, I think 1977 was when they got their dual mandate of employment and stable prices. They'll do it again. And instead of that being their purpose and their cause and their dual mandate, they'll have one mandate, which is just fund U.S. government debt financing. And so one of those two things is going to happen. They'll either do it voluntarily or Congress will just rewrite their act.
Yeah, I've noticed Powell when he said that under no circumstances basically would I monetize U.S. government debt, which has led me to believe shortly before reverse repo runs out or shortly after, as the TGA gets, as economic doomsday gets closer when the government fails that auction, something will happen to Powell. They'll replace him. He'll retire for family reasons. But I've always said that the day they replace Powell, that's the day you need to panic about inflation, because I do think that's coming. And I don't think Powell wants to be remembered that way. I think he will hold that line until they replace him.
Yeah, he very well could. One kind of another way that this plays out is that when the reverse repo facility dries up, the money supply starts tanking again, just like it was before. we could very easily see the inflation rate dip. If a recession hits hard, unemployment hits, prices collapse. That's what happens. And so we could very easily see the inflation rate just plummet. We could actually see deflation, which is something that I have incorrectly forecasted for a while now. But it's something that you typically see when economic pain hits hard enough, prices collapse because nobody's buying anything anymore. You get that kind of that deflationary spiral. If that happens, then Powell actually does have no excuse anymore. It's the reason why he abandoned tightening back in the end of 2018. There was no inflation there, so he had no excuse to try and keep tightening. He could go back to not QE. And so if we see deflation or dropping inflation rate before the government has a failed auction, then we could see the justification for a return to QE because inflation has already been defeated. In which case it'll come back with a vengeance.
Yeah, I mean, we just got Jim Cramer was just on TV 2 days ago declaring the soft landing, that inflation was dead after the CPI reading. Of course, that had everybody panicking. Oh no. And not a very soft landing scenario you're describing there. So yeah. What might it look like? We talked about the spending down of the TGA. I mean, would they create some new acronym, you know, some new not QE, like the Bank Term Funding Program was totally not QE, and it wasn't QE after Repo Madness in 2018 when that happened. Would it look like some other type of program, or do you think total rewrite of the Federal Reserve Act, like you were saying?
Well, one thing I'll say is it's important to watch the money supply. Because not all Fed balance sheet movement is created equal. So when we look at the Bank Term Funding Program that happened where their balance sheet spiked, nothing happened to the money supply. The reason why is because, like, I look at it like a brokerage account. This is just an account that they have with assets in it. So if in your brokerage account, you've got stocks, you got ETFs, mutual funds, cash, bonds, whatever in there. Those are all different things and work differently. So when we saw their balance sheet spike, what was going on behind the scenes was that there were some bank accounts with deposits in them that, absent intervention, would have ceased to exist. So their balance sheet exploded in order to refill those deposits in those bank accounts so that they did not cease to exist. So that means the money supply stayed the same. It would have dropped significantly, but instead it stayed the same. That's one of the reasons why we didn't get inflation following the QE that started in the financial crisis, because it wasn't necessarily money printing, it was reserves printing. It was making sure that the deposits, that the money supply didn't plummet. And so that's one thing that I'm going to be watching very closely is, you know, what happens to the money supply. And I know that the data is lagged, but when we see the result of what the money supply does as a result of reverse repo facility money going in, the money supply stays stagnant. So when we get a return to QE or debt monetization or yield curve control or whatever it is that we have that ends up essentially funding the government's spending through the creation of new dollars, that is a direct increase of the money supply. And that will be absolutely inflationary. Even if it doesn't look like, you know, on their balance sheet like other expansions have. What we have to watch is the money supply increasing? And is that happening as a result of new dollars coming into existence? And if new dollars are coming into existence and it's increasing the money supply, then yeah, we're going to have inflation. And also, we're going to have higher rates for everybody but the government. So we're not going to get the bailout this next time. Just the government is.
It's nice of them, always looking out for number one.
Yeah.
Last question, Joe. For these last 2 weeks here, ever since Bill Ackman covered his short on U.S. Treasuries, we've seen quite a substantial dip in the 10-year Treasury yield, right? We peaked just over 5%. And for the last 2 weeks down, we've come now down about 50 basis points from the peak. This decline in the 10 years, where is this buying coming from? We know it's not China. We know it's not Japan. And we know it's not the Fed, or at least I suspect it's not the Fed. Is the reverse repo drain somehow contributing to this mini bull market that we've seen in bonds for the last 2 weeks? Is this money coming from somewhere else? What do you think this is playing a role here?
Yeah, could have a little bit of a role. Most of this is because of the signal that from the Bill Ackman covering the shorts, basically like, hey, if the world gets crazy enough, then everybody's going to buy treasuries. And so the idea is, okay, well, I want to buy treasuries ahead of that because now I'm front running that price increase, which pushes yields down. The other thing contributing to this is the inflation print, which is, it was obviously, I know you talked about this, but, a 34% drop in health insurance prices. Like,
that's great news.
Exactly. Yeah. I want to
finally made healthcare more affordable. All right.
Right. So, obviously I don't think, the inflation prints are accurate, but this was one of them, because if you see prices coming down in the future, you're going to be buying debt, because now okay, well, the Fed's not going to have to continue raising rates, and so this is a safe buy right now because they're not going to force a capital loss on me. And then finally, we now are seeing the market starting to price in interest rate cuts by the Fed for next year, as a result of inflation dropping and as a result of, a potential recession and hard economic times. And so those things are contributing to what I believe is a false narrative that that long-term treasuries are a good buy right now. The reason why I believe that's false is because the price of anything is determined by supply and demand. So you're anticipating that the demand for treasuries will outpace the supply. And I could be wrong about this, but it looks like the safe haven, the part of treasuries that are considered, a safe haven asset, that rationale is declining globally. And the biggest buyers of treasuries historically are no longer buying. And so you're really relying on like a big, shift from asset managers to go from stocks to bonds. And you're banking on the fact that that will be a big enough shift to fund U.S. government spending at current rates. And I think that's a bet that might be misplaced. So
in reality, the government is essentially dipping into our pensions to fund their debt spending at this point. If foreign governments won't buy it and the Fed, at least as of now, won't monetize it, who's left? U.S. citizens, right? Through their asset managers, through their pension funds. That's the last buyer that's left in the market at this point.
Yeah.
And so,
yeah. And it's also true that every dollar has a treasury behind it. Because when you follow if you are a saver, if you have dollars, they're not in a fixed income fund or anything like that, just straight cash in any account, whether it's a brokerage account or an IRA or a bank account, behind the scenes, usually that institution is holding a treasury as the collateral. And so they're, in system wide, they're, almost not one and the same, but they're very connected. And so if we do see, a big sell-off from equities, big pile up of cash, well, then that indirectly does the same thing.
Right. So let me ask you this: any chance in your mind, or if there is any chance, what would you handicap? What are the odds that they don't go back to ZIRP and BRRRR? I mean, I still look at there's a fork ahead in the road, and we can choose the option of deflationary default or hyperinflationary default. I'm guessing you're leaning more towards the inflationary, but if you had to handicap it, where would you say, what are the odds of one or the other?
I actually think it'll be both. It's just a matter of timing. So if I were to put a time frame on this, I would say the pain and the price is falling, and the higher rates will last for a lot longer right now than most people think. Like, I don't think the reverse repo facility is going to hit zero on February 1st, and then everything is going to collapse February 2nd, and then a return to massive inflation and money printing February 3rd. I think that these things usually take a lot more time to play out than I'm always surprised at how long it takes. I was just considering making a video recently about right now it feels very similar to January 2020. In January 2020, I was making videos about, hey, the stock market is melting up despite all of fundamentals. It doesn't make sense. It should be falling, but it's doing the opposite. Like,
Check.
what am I doing wrong? Like, this doesn't make any sense. And I was, even at that time, I was talking about COVID at the time, coronavirus, and like, you know, hey, like, you know, people, you know, you should buy some things to keep in your home and buy some pharmaceutical companies, and like, and nothing was happening in the market. I was like, this just doesn't make sense. Obviously, towards the end of February, everything started to collapse, but it always takes so much longer. I mean, Ron Paul was talking about the housing crisis, the housing bubble in 2001. 2001. There's videos on YouTube you can find from then when he's talking about this in front of Congress, I believe. And so these things take a lot longer to unfold. And so if I were to guess, I would say 2024 will be, you know, marked by economic pain, rising unemployment. I think the official recession will begin. We'll still see higher rates. We're not going to see the drop in rates that everybody's expecting. And we'll continue to see, you know, kind of a chugging along through some economic pain. And then maybe towards the very end of 2024 is when things will get to a point where they'll have to flip the switch, and then we'll see them go back to some sort of QE to monetize the government's debt.
It's a great case study in why you really got to be careful, you guys who are putting shorts on in the market. Markets can stay irrational longer than you can stay solvent, as the saying goes. And the last few years, I think, have been living proof of that, because there's always run down the TGA or treasury buybacks, or we're going to issue more in the front end of the curve versus the long end, things they can do to delay it. So you can be right and still lose everything. So be careful, you guys, with the shorts that are out there. That's
the only smart thing Keynes has ever said.
That was Keynes? Is that who I've been quoting this whole time? Oh, God, I feel dirty. Well, this has been fun. I'm going to go take a shower now that I learned that. Joe, thank you very much for being with us today. I'll give you the last word, sir.
No, that's great. Thank you for having me.
Anytime. Welcome back anytime. That's Joe Brown, folks. I'll put links down in the description from Heresy Financial. He's one of the best ones out there. Thanks again, Joe. And everybody, until next time, live small and dream big.